My guest today is Vibha Padalkar, who's the MD and CEO of HDFC Life Insurance. The company came out with results which beat street expectations. Uh, Vibha, thank you very much for joining us on BloombergQuint. To begin, you ended the year with a growth of 22% as far as value of new business is concerned. How sustainable is this kind of growth?
We believe that this is very much sustainable. I just want to rewind a little bit back into history since our listing, which was about 4.5 years ago. And this is, we thought, an opportune time to see how we have tracked on most metrics. And if you were to look at new business growth, renewal premium, embedded value, our protection growth, value of new business, you will see that we have at least grown by 2x over the past 4 years, if not slightly higher. And the final part is even the expansion that you see in persistency, both 13-month and 61st-month persistency. So to your question, given that we've had 2x or doubling of our new business growth over 4 years, that very much translates to the kind of numbers that we feel reasonably sure about, in the range of about 17 to 18%.
Okay, in sense 17 to 18%, or again, next over the next 3 to 4 years, every year you can give out that kind of growth. That's what
Absolutely.
You're saying.
Yeah, and when you triangulate that with expected GDP growth for the country, typically the sector has grown faster than 2x GDP over a slightly longer horizon, maybe 3 or 4 years. So I'm leaving out pandemic as a one-off. So no reason to believe that insurance as a proposition on the back of a lot of product innovation, go to market with technology, use of aspects like Meditech, will mean that we'll be able to continually go back to the customer with products that make a lot of sense for him or her.
If you look at the margins have also done very well, actually. 27.4%, the VNB margins for the fiscal. Is there any scope to take it up to 30%? What kind of levers that you have to take it to 30%?
Yes, we will continue to aspire to take it up to 30%. And like you rightly said, every year there has been a smooth upward curve on new business margin. And like I mentioned, we have doubled our VNB, our value of new business, over the past 4 years. So some of the levers that we have are further product innovation, which helps us capture market right at the start. Also in terms of expense leverage, combined with just volumes going up, but fixed costs not going up, which is the leverage that will come through across our channels. Also, what will help us is the Exide Life acquisition. That too will help us as synergies, both in terms of cost synergies as well as overall productivity gains start coming through. So combination of all of these factors would mean that margin expansion is certainly on the card. I'm not even mentioning the potential upside of the HDFC Bank and HDFC.
I will be coming to that part of it as well.
Yeah. So just to summarize, I'm not even counting that. That will be possibly over and above as and when regulatory approvals come through.
Okay. You spoke about the Exide Life insurance. When it comes to and comes into the combined into the entity, what is the kind of growth that it is going to bring in additional growth? So when you mentioned 17 to 18% every year, for the next financial year, will it be in the same range, or is it minus Exide you were talking about?
No, it will very much be even on a standalone basis, we will be able to grow as well. Even today, if you were to look at it, Exide Life has comfortably grown faster than private industry growth. So I'm fairly gung-ho that they will continue. So if you look at their growth in the 12 months, they've grown 22%, more than 2x of overall industry growth. So I do have reason to believe that traction will continue. So them on a standalone basis and us on a standalone basis, and collectively, of course, it should be more than a sum of the parts.
What about the VNB margin part? When it comes in, will it have a temporary blip or some impact on your margin?
So what we are aspiring to do is that on merger, that we are margin neutral for some time. So we end FY23, assuming that the merger happens this year. We end FY23 margin neutral versus FY22, and thereafter, the following year after, we will start growing again.
What kind of synergies that you can get from Exide? Can you give us some idea of how that is going to bring in more business for you?
Yeah, in every which way, as we get into the details, and now it is a 100% subsidiary. So we have had a chance to look at them very closely. So offering our products to Exide Life's current customers, also for us to be able to penetrate deeper and cross-sell opportunities with their existing customers. Also, the power of having deeper pockets in a way, in terms of investing in technology, investing in outreach to the customer. So several, you pick up every business line that they do currently, and the synergies start becoming fairly obvious. So we will have to work through the details, and both in terms of productivity synergies, as well as how can we optimize on our cost structure. Do we really need two branches on two ends of the street, for example, and so on? Can we harmonize that post the merger? We will look at all of those aspects.
Is there a value that you have assigned to those synergies?
We are still working on them as we try and understand some of their costs and where can we. So it's not only from their side. We might have some branches that are coming up for renewal. We might not want to do that if Exide Life has a better branch, or a branch that's satisfied. It's already there and it satisfies our requirements. Mm-hmm. So it's really collective synergies. But really, rather than a cost number, what we're looking at is how can we bring margin convergence. So the focus is on growth of the acquired entity, rather than just extraction of or taking out the costs.
Okay. You mentioned briefly about the merger of HDFC and HDFC Bank. How does it play out for you? You do have a big business coming from HDFC Bank today, but once you're a subsidiary of HDFC Bank after the merger, how does it play out for you?
So clearly, as a subsidiary, there will be complete alignment. Also, so far, we've all looked at our own businesses in terms of opportunities to reach out to customers. Every business house is looking at how you can pool together with the analytics to be able to give an entire experience to the customer. For example, the customer starts off with a small, just a savings account, graduates to putting a small SIP, SIP, for example, then graduates to perhaps buying the first home, taking the first insurance because he or she has bought that home, and so on, and for ending up with retirement products, retirement solutions, the entire life cycle of every financial services product. So the way of thinking would be as a financial powerhouse as against only a bank. And what do you do with very loyal customers who are very inclined to buying products from HDFC Group because of their high quality, trust factor, innovation, especially in life insurance, and so on. So this is just the tip of the iceberg as to what we do when we all come across in this synergistic manner.
So, you still have that access to those outlets, right? When the branch outlets which HDFC Bank has, what has prevented you to expand and sell it across, aside of the fact that it's an attached product to a loan or something which is currently being given out? What is preventing today HDFC Life from cross-selling or stepping up your products there?
So what happens when there isn't a complete structural alignment is that we are looking at somebody who walks into a branch, you're tactically saying, do you want an insurance product? What I'm saying is that when somebody walks into the branch, there's almost a scorecard that is there, that this person has this account, that this could be as a profile of this person. This person has a bank account but doesn't have a mortgage. This person. So what are you upselling and thinking that the customer might want, or this is what the customer might be delighted with? we're not looking at it in that manner. So you're moving from the tactical conversation with the customer to a very holistic conversation with the customer. You're almost preempting to say that the customer will benefit from managing his or her affairs in this particular manner. Or we could give a preferential deal to the customer, because it could be, for example, as simple as simplified underwriting. I can ask that customer no financial information, because we know what that customer has, perhaps in terms of his financial or her financial score, or a medical score from our customer base. So it's those sorts of things, of course, within data protection norms, but still there's a lot of using of data, using of technology to be able to holistically look at how where the customer is. For example, we do a lot of that within HDFC Life to say, what is the first product the customer has bought? Who in his or her family is the second one who buys it? Why? At what point does a drop-off happen? When a customer is filling proposal form, out of every 100, we are converting 61. So we use a lot of this analytics, but can we use it now across the group? That is what opens up the possibilities.
There's also a proposal to increase the stake of HDFC Bank to 51% from 47 odd percent. And as you grow, you would need more capital as well. Will that come in form of HDFC Bank increasing stake in your company?
So HDFC Bank and HDFC have said that they would seek regulatory approval to increase stake to 50%. Like a lot of banks are today holding more than 50% in their respective insurance companies. So the intention is certainly there. We would also like to shore up our capital over the foreseeable future, so that it can spur growth. We do have adequate capital. We have done we are in the process of going ahead with a sub-debt issue, because we've had an acquisition and we haven't raised capital. But some of these things will evolve over the next few months as there is more regulatory clarity on that.
As you look at doubling yourself every 4 years, what is the kind of capital requirement that is there for life? Assuming that you are comfortable at 180 to 190% of a solvency level.
Yeah. So we'll remain at that level. That has been our stated objective. And the regulatory requirement is only 150%.
That's right. Yeah.
Yeah. So I think 180 to 190%, we would go back to those kind of levels.
What would be that capital requirement?
So right now we are about 176%. For us to go to those kind of levels, it would translate to maybe 1,000-1,500 crores of capital.
Okay. And when you are saying that you may look at equity and debt going forward to capitalize yourself for this growth, you are doing a tier 2 capital raising, which is now, so it could be in the range of 1,000 to 1,500 crores of capital that may be required over the next 3 to 4 years. That's what you're saying, right?
Yeah, more like 1,000 to get to about 190 to 200%. 1,500 will get us comfortably above that.
Okay. Protection is one area where you've been growing well, 24%, if I'm not wrong. That's the growth rate that you had. How do you see protection products growing for you going forward?
We are targeting in FY23 a growth of comfortable double digits, and we are hopeful of doing a lot of things to at least to stem the drop off. So today out of 100, we convert about 61. And this is 100 customers who actually filled in the proposal form, paid the money, and we're not able to convert for various reasons. So we're really getting into nuanced level of detail to say, what can we do if X document is not available for our financial underwriting? Can we do with some other proxy to get to the same answer as to can we issue a policy or not? Can we have a Meditech proxy for medical underwriting because that individual is unable or unwilling to go into a medical center to do their tests for insurance? So can we have a solution for, say, identifying at least the non-extreme cases of, say, diabetes or hypertension or some of the other illnesses, maybe what are called as lifestyle illnesses? Can we do that? So we do work with the startup community. Some of the use cases are already into production. So a lot of these things can be done. So our target is to start showing growth in retail protection, hopefully with the pandemic having receded.
So, between savings and protection, the focus will be more on protection for you going forward, or you mean where is the emphasis going to be in that sense?
It's really both, because if you look at savings, India has been a savings led insurance market. So that's not going to change overnight. So in a way, if you like, that's our bread and butter. And that is very well entrenched into how uh, a lot of people buy their life insurance. What we call conversion certainty is very high. Similarly, the practical realities are, if my salesperson on the field has 10 minutes, he or she is probably going to pitch a savings policy, and the customer also would like to look at savings along with a life cover, maybe 10 times the premium side. However, term is something that is really pure protection, if you like, and it is the right product to sell, and it is also a need of the hour, wherein you're looking at a cover of maybe 200 times to 400 times the first year policy. So it is really both. For some time, at least until the sector starts getting traction in being able to make meaningful growth, show meaningful growth in term, it will take time. It will take also a lot of effort, because you need both financial and medical underwriting. You also need reinsurer help. So all of that needs to come together, but one has to make a beginning somewhere. We have been big believers in term. We've been one of the first movers in online term also. There has been a bit of a hiccup thanks to the pandemic, but that's not entirely unusual either, or hasn't really taken us by surprise. So some of the slides we have put in our investor presentation also show how the journey of term over the years in India has happened, and also term prices and so on. So putting everything into context, I think low hanging fruit are certainly there to be able to grow double digit.
We were, between VNB margin inching towards 30 is your medium term goal, and market share. How do you manage that and balance that?
It's a very important and interesting question, because for us, growth is non-negotiable, and so is growth in our VNB as well as margins. It's not that difficult. If we were to drop one place in our market share ranking, it is relatively simple to show very high levels of NBM, or new business margin. What is a lot more difficult is to hold on to your market share, market ranking, as well as grow. But really for us, we have to deliver both. And that's what keeps us very enthused in solving for that.
And it would be easy, considering that you have a new, the big boy is coming into the market. LIC is going to be listed soon. How will it change the dynamics for you competition wise? Of course, market would look at valuation. LIC is much lower valued as compared to HDFC Life, but from on ground competition, how does it look like for you?
Frankly, I believe that IPO or a corporate event is slightly different from business, because there's nothing that pre-IPO avatar and post-IPO, what does it really do in terms of business that one couldn't do in a pre-IPO avatar? I don't really think. So I think we're sometimes mixing up two different objectives, if you like. As far as the listing per se is concerned, we completely welcome it for the largest financial institution in the space to not be listed perhaps is suboptimal. So it's good in terms of transparency and just growing up of the sector. As far as business is concerned, that's entirely different. And frankly, I think all of us should be looking at expanding the pie rather than saying who gets what slice of that pie. Because when you triangulate whole host of metrics as to penetration, we as a sector, we are lower than where we ourselves were. Or if you look at pension assets as a percentage of GDP, it's less than 5%. So, more and more people are getting into the older net, if you like. So there is enough for all companies to, the 23 life
Mm,
insurance
I,
companies.
I I get the macro picture part of it. I'm trying to look at from the point of view that once you list, there are market pressures, business models which analysts talk about. They refer to the leaders or benchmarks in the sector, and that's where competition also comes in because the new player would like to get a valuation similar to that. So when that happens, again the issue what I was talking about, balancing VNB margins versus market share, that comes into play here.
We'll have to see how they manage that. The margins that have been put out are sub 10%. So expectation clearly will be to take it up from here. At the same time, there will be growth expectation. I think that's what keeps things interesting. And every newly listed company will go through that self-discovery as to various objectives that one is expected to deliver on. A little bit early days in my view. We'll have to see a couple of quarters to see how things are panning out after they go public.
Vibha, it's been a pleasure talking to you today. Thank you very much for joining us on BloombergQuint.
Thank you so much, Sajid.
Thank you.